Hey everybody, welcome to the Ag Commodity Corner Plus podcast. It is 16th of Jan 2026 and this is week 41. Mo, what's our topic for today?
Yeah, it's 2026 USDA January crop report. Bearish shock plus Canada-China trade deal for week number 41. Let's get into the weekly summary quote chart, and you can see that despite corn being down 21 cents for the week, it actually closed higher than the low from Monday's close. So a little bit of a bounce, could be a dead cat bounce. Soybeans also bouncing from the low from Monday as corn acted like an anchor, down about 5 cents, but looking to maybe form a double bottom there. Soy oil was the star of this past week. And remember, last week we had a lot of green on the screen. This week, not so much. But we had some headline news on soy oil as well as canola. We'll get into that. We're not going to talk about the hogs, but the hogs have been on a tear. All contracts, futures, new contract highs. It started with the summer months that were reflecting a lot of disease in the Midwest. There's even rampant PED here in Ontario. And now the nearbys are catching up. There's some catching fire here near term. There's a new viral PRRS virus in the Midwest, in Iowa, and it's in some cases it's the worst they've ever seen. So, and then we've got Bitcoin catching some buying here this week, almost back to 100,000. Gold was the same old story there. New contract highs. Same thing with silver. Silver's actually gone parabolic. We'll get into that here. So, let's start off with this shocking bearish USDA report, mostly for corn.
Let's start with that. The first set of USDA reports from the USDA. We had that on Monday. Normally, the Jan worst day is the final supply outlook for the prior year's crop. And I know you'll get into some of those charts which reflect those bearish numbers. But to start with, it was generally bearish for corn, soybeans, and wheat, more for corn. US 2025 corn harvested area came in 1.3% above the September estimate. And this is due to an increase in both major and minor states that produce corn. 91.26 is the harvested acreage, and this is the highest since 1933. And this was significantly raised from the September number. That's up 4.5 since the June survey as well. When you look at the acreage numbers, corn yield came in at a record 186.5, and ending stocks were higher than expected. But more, a big question that I have is, do you think the USDA had all the info that it needed to produce this report? How good are these numbers?
Well, this report was bearish corn, there's no question. We've talked about this in the past, and in our last podcast last week, we were hoping for a USDA bullish surprise. Based on the evidence that we had, it should have came in lower, but I think the yields almost came in unchanged because the USDA has no clue what they're talking about. And here's why. We had two concerns going into this report. We've talked about it in the past. One of our concerns was when when the government was shut down in October, Doge and Trump and Musk were trying to get rid of waste in Washington, and I've been told that the staffing at the USDA is at half of what it normally is. And then we never got that October crop report. And that October crop report is so important because the USDA goes and harvests their plots. They weigh the corn and the beans. I don't think they did. We've been told that a lot of the USDA people had no access to nothing. And so I think the yields were unchanged because I don't think they know whether disease or dry finish impacted the yield. So the next report that may give you some idea whether this report was accurate is the March 1 quarterly grain stocks report at the end of March. And you can see here from this chart that ending stocks are higher, but it's not the end of the world. The USDA could have printed a 2425. It's going to be tough to get past another 500 million bushels of corn. That's the problem. And, global ending stocks are lower again for the 10th year in a row, but we've known this for some time. But, sort of a silver lining despite a very bearish report.
From there, let's quickly just look at the demand side of the equation for both soybeans and corn. So a silver bullet or game changer could be the new biofuel slash E15 policies. The U.S. admin, as of today's headlines, plans to finalize 2026 biofuel blending quotas by early March, keeping them close to its initial proposal while dropping a plan to penalize imports of renewable fuels and feedstocks. If finalized, the plan would mark a partial compromise between rival oil and farm industry groups, and it would include mandated volumes of 5.2 to 5.6 billion gallons for 2026. That's on the biodiesel side, versus the June proposal of 5.6 and the prior year at 3.35. More that 5.2 to 5.6 is a slight reduction, would you say, from the earlier June proposal of 5.6?
Yeah, it's maybe, but it's better than what the trade was talking about, because they were talking something of a worst case scenario. It's still higher than the prior number at 3.35. So all in all, it would be nice. But I mean, again, he's taking a very long time to finalize these. Can we plan in 2026 for this? Not really. You know, this is probably more of a 27. And just a warning, when the government reopened, they funded the U.S. government till the end of January. We could be back in the dark again, and this thing gets delayed and kicked down the road again. So, you know, E15, we've been talking E15 for some time, but and Washington's talking about attaching E15 legislation as part of other bills to try to pass it in Congress, but that takes a long time. Over a 5-year period, we could maybe use up another 2 billion bushels, but it doesn't help prices in 2026.
Let's look at the price chart. So this is March corn, and following towards the end of that chart, as you guys can see, following that Monday bearish crop report release, corn fell by over 24 cents. The technical break below 4.32 and a quarter is bearish near term. Support comes in at that prior low near 4.1, and that's possibly where we are headed more. What do you think?
Well, so the bounce this week is positive. It could be a dead cat bounce, because remember, when markets test certain supports or fall as much as they did, you tend to get a quick corrective bounce higher. We did hold the August low, so that's good news too. But my concern is over the next 2 months, what's going to change to allow this to come back up for air? And the safrinha corn crop's not till April. Yes, demand's strong, and some think the trade thinks we can export ourselves out of this, but I doubt it. I mean, exports are up 30%. How much higher do you want them? Maybe China comes in, buys some corn. We have seen some daily flash announcements of to unknown, and they could as part of a trade deal. Trump and Xi are not expected to meet till April, so I have a funny feeling you need to buy a couple months, and I think the funds could easily bleed this lower. And then the other problem with corn in particular, well, and just grains in general, beans and wheat, is prices have come down since 2022 highs, but your inputs have stayed high. And I don't know how you're going to break this. So you need that domestic demand to drive that price higher. Paying farmers a check, and they're now talking another 15, 17 billion for the U.S. farmer maybe by September, when they still haven't even gotten the first bridge payment of 12 billion by February 28th. And by the way, that drop in corn of 24 cents on Monday offset what they were going to get on February 28th. So none of this is working. Just let the price of corn, move higher. If we could get $6 corn and have the farmer make money, you wouldn't have to pay out any of these amounts. So it's very, very frustrating.
And sticking to the demand side, this year is the U.S. corn export sales to China. We had that trade truce in November when Trump and Xi met, and the initial pledge was for 12 million metric tons of sales to China. The initial target was to hit it by end of year 2025. We seem to have hit that target by mid-Jan, if you include all the unknown destination sales as well. What next, Mo?
Well, so we finally achieved the 12 after all the noise saying, oh, it's the end of February or the end of the growing season. And so it was a little bit later than the commitment at the end of 25. The question now, does China go beyond the 12 million? Did they start buying part of their 25 million metric tons for 26, 27? Do they do a counter seasonal? Remember, this is not about economics. It's more about politics and a trade deal. And who knows? I mean, Xi and Trump are not expected to meet again till April. So for now, the beans have bottomed. You can see from this chart that they've bounced as well, creating maybe a double bottom.
Soy oil chart.
The soy oil chart. So the news on the biofuel has provided some strength to soy oil, but again, I don't know if that's more of a kick the can down the road, so we'll have to wait and see. It's still nowhere near the highs from last August. And then you can see from the soybean chart that you got a potential double bottom. And if you go back to this high here, okay, and there's some resistance at 1065, this was when the funds were almost record long. China was buying, but do you remember that we had a weather scare in Brazil? Brazil was dry in both October and November. It's too bad we were in the dark. The government was shut down. We had no idea that the funds were record long. And remember what I've told everyone in past podcasts. When you're well above the 200-day moving average, what do? You know what to do. Anyways, so don't forget about our program. See this here, this little smartphone. When the USDA report comes out, we do a live USDA webinar, and then we tell our clients what happened and what to do, if anything. So try the program. You'll get a ton of insight from us, and we definitely think we can help you make better marketing decisions.
Oilseeds seem to be having things better off than the primary grain. So from soybeans, if we move over to canola, there's headline news that China and Canada have agreed to possibly a trade truce or a trade deal. And the sticky points, as we know from last year, were EVs and canola. So Canada's PM Carney said Canada expects China to drop the canola seed duties to 15% from the earlier 84%, and this is supposed to kick in by March the 1st. And the visit by Carney to China also means that on the EV side, Canada would initially allow about 49,000 Chinese EV vehicles at a tariff of 6.1% on a most favored nation basis as far as trade is concerned, with import quotas that will expand over time.
Yeah, very positive canola. You can see from the chart, double bottom V-shaped recovery. We don't get V-shaped recoveries in the grains too often, but you're getting one here. And we're getting a fun short covering rally. We were short about 100,000 and as we ended 2025. Look for a break above resistance at 650. From here on in, you're going to need the fundamentals to kick in to drive prices higher, but I would not be surprised if we retest the 200-day moving average around that 667. And we were telling our clients what to do with canola. Many in the trade were very bearish and thinking that this was going to break below 600. And we actually told our clients exactly what happened today, the announcement. We said Carney should allow EVs to come into Canada. The Chinese manufacturers could build plants in Ontario and create some jobs, and that looks like that may happen into the future. So we would hesitate, and even in our monthly basis report, we told our members that you should wait for higher prices, and that's what's going to happen.
Looking at crude oil, news that Trump was not going to attack Iran and start a war has sent crude oil futures lower. Funds removed some geopolitical risk from futures, and futures seem to have created a double bottom near term, but the 200-day moving average is acting as a resistance. Is this more noise, Mo?
More noise, you got it. I don't. This chart here shows that we could maybe trade higher back to 68 or 70, but remember that global glut of supply, it's still there despite all this noise. So who knows how it all pans out here in the near future, but we still think that crude will trade lower, not higher short term.
Moving on and looking at that parabolic chart, this is weekly silver futures and safe haven assets in the form of precious metals took off last year following Trump's presidency and trade wars and the economic certainty. Nations like China seem to be hoarding precious metals, and it continues to be the same case in 2026. And in 2025, the biggest gainer among commodities was, again, silver, up a whopping 141% or so. And a distant second was gold, coming in at 64%. And looking at the last decade of price action, silver futures are up by about 825%. And that compares to gold at 721. The stock market index, S&P 500 at 692, and NASDAQ at just 459.
Buyer beware. I would not be going long. I mean, I know this chart shows you that we could go considerably higher, but when we've learned, I've been doing this for 42 years, trading stocks and commodities, and I've learned that when things go parabolic 90 degrees to the top side, sit on the sidelines. I don't even know if I want to go short, because if I tried to go short, I might get if this were to jump to this high, I mean, the losses would just be immense. So I'll watch from the sidelines and admire the big gains.
Let's look at that drought situation in North America. A locked-in drought this winter for the whole of North America will be tough to break. And looking at the latest U.S. drought monitor numbers, U.S. Midwest drought east week on week from 71.61% the prior week to about 62% as of Jan the 13th. This, though, compares to 28.18 in that mega drought year of 2012 during the same time. 59% of U.S. corn area is in D0 to D4, which are drought conditions as of now, and 63% of soybeans are in drought conditions, and this compares to about 45% in 2012 and 37% for soybeans.
Ontario Ag has 97% in a drought. Western Canada Ag, 77% in a drought. That's down from 84% at the end of last year. Folks, there's only one thing that's going to change this price pattern, and it's a supply scare. Weather, supply scare from either somewhere in the world or from the United States. We've locked in a drought for the winter. You talk to any meteorologist or climatologist, and they'll say to you that you cannot get out of this in the spring. The chances of coming out of this is very small, because you'll get topsoil moisture, but it's trying to fix that subsoil moisture. That could take years. And so it's too early to get excited, but that's what you're going to need if you want corn back to 6 or 7 or 8 or whatever that number is. And so we're very, very concerned, but it's early. And it's too early to get excited. Finally, the CFTC report.
Let's finish off with that fresh off the press CFTC numbers. So data is as of the 13th of Jan, and as you guys can see, heavy selling in corn and soybeans. So in corn, funds reduced, or rather increased their net short position by over 65,000 contracts, going into 81,000, over that actually. And in soybeans, they cut their net long position by over 44,000 contracts, taking their net length to almost 13,000. In real time, though, on the corn side, we could be short about 75,000. That's what trade thinks, owing to some buying this week possibly. And on the soybean side, again, we could be thereabouts. closer to that 12,000.
And in canola, you can see the minus 81,000 here in the latest report. But after this week's news and the buying and higher futures, I don't know, maybe closer to a minus 30,000. At some point, I think they'll go neutral. They were just too bearish. As I said earlier, the trade was just too bearish. So thanks for watching, folks. Don't forget to subscribe to the channel. Don't forget, Monday is Martin Luther King, so it's a holiday. The markets are closed. We'll catch you again next Friday. Take care and have a great weekend.
Bye, guys.